Mortgage, 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 mortgage. This is Chris Trapani, the Mortgage Pro, and today I'm going to share with you what is a conventional loan, how does it work, how do you qualify. The most important part about qualifying for a loan is, number one, credit. What does a conventional loan look for? Well, first of all, you must have a minimum of a 620 FICO score. You know, FHA and VA, they can do considerably lower, but on conventional, we're looking at a 620 minimum FICO score. Now, the lower the score, the higher the interest rate. So sometimes you might want to take a look at a different loan if you're in the lower spectrum, or consider credit repair. Look, there's a lot of great people out there with credit repair who know, and I have some guys who do the real deal. But here's what you don't want to do if you're in that lower end and go into credit repair. This is just a point to note. Never pay somebody a monthly fee. If you're paying them a monthly fee, what's their incentive to get it done? They'll drag it out forever. So don't pay a monthly fee. You're looking for the lump sum guy who knows what he's doing, who's going to get it done. Raise your FICO score if possible and lower your interest rate. So that's step number one. We know the credit score is going to be 620, but there's a couple of other requirements. If you've had a bad situation in your life, if you've had a bankruptcy, 4 years must have elapsed since the discharge, since it was totally complete, not since you started it, since it was completed. And if you've had a foreclosure, in order to get a conventional loan, 7 years must have passed. So if you're in less than 7 years, if that's happened to you, you'll have to consider a different type of loan, more like an FHA loan. So now we have an idea of the credit. We also have to make sure that you don't have too much collections. See, people with lower scores often have collection accounts. So if you have a collection account of maybe, I'm going to make up a number, $4,000, because that happens all the time, you know, a car or something bad, okay, as long as it's not medical, we're going to hold 5% of it against you as a payment, as if a $4,000, as if you had a $200 car payment, that's 5%. So let's assume your credit's good. Your credit's good, we can look at a couple of different programs. What are we going to look at for down payment? Well, if you fall into a first-time homebuyer program or first-time homebuyer situation, you could put as little as 3% down with a conventional loan. That's even less than FHA. Does that mean it's always the right loan for you? Not exactly. Let me explain. If you're at 3% down payment and there is a maximum income, we have a couple of programs for Fannie Mae and Freddie Mac. One is called Home Possible and the other is called Home Ready. You actually get a discount on the interest rate and a discount on the mortgage insurance. So remember, if you put less than 20% down, you're going to have to pay mortgage insurance in one form or another. But I'll talk about that later. So let's take a look at a high FICO score. And if you fall into the Home Ready or Home Possible program, you get a couple of discounts, plus you get the lower PMI rate. You can actually buy a home with less money out of pocket than FHA, and your monthly payment will be lower, and there'll be a distinctive advantage for you. The distinct advantage is on a conventional loan, PMI, the mortgage insurance that you pay to protect the lender, will actually go away once you have 20% equity. Hey, look, that might take, you know, a couple of years. It might take 15 years. It all depends on what your situation is. But if the house appreciates in a couple of years, you might have 20% equity. On FHA, if you use a minimum down program, you're going to pay PMI forever for as long as you have that loan. So that's a distinct advantage of a conventional loan. But if you're in the low FICO score and the interest rate is going to be higher than FHA and the PMI rate is going to be higher, and if you're above the maximum incomes for the Home Ready and Home Possible, it's going to be even higher. So there are advantages to both programs, and as a walking calculator, and most loan officers can do this, we see what your FICO score is, we see how much money you have, we see your income, we see a few different things, how much debt you have. We evaluate it, and a good loan officer is going to tell you right away, this is the right loan for you. And sometimes it's conventional, sometimes it's FHA. Now, if you have a large down payment, 20% or more, regardless of your FICO score, it's almost always going to make sense. Not always, but almost always going to make sense to go with a conventional loan. You don't pay the PMI, and 20% down, you're going to pay a little bit less on the interest rate. So we're all good there. But as low as 3% down, the myths of 20% down, they're long gone. Don't worry about it. Now, another advantage to conventional loans is you can buy investment properties or second homes. See, on a VA loan or an FHA loan, that is for owner-occupied only. If it's a conventional loan, you need to take a look and say, hey, am I going to live there? Am I going to rent this out? Now, when you're buying a rental home, an investment property, look, you're going to have a little bit of a higher interest rate, but that's fair because the risk is higher. But you're also going to be required to put a larger down payment. You're not going to get a 3% down payment. Minimum is usually 15% down, but you have to pay PMI. Really, you should look at 20, and the sweet spot on the interest rate is when you put 25% down on a rental. Now, you could buy a second home, for example, if you're buying in a resort community, someplace that you might want to go for weekends, that type of thing. Not the house next door. You can't get away with that. It should be in a resort community. They wanted a certain amount of miles away from your regular residence, and you could buy a second home, and you could do that with like 5% down, no problem. So that's pretty easy. They're pretty easy on the guidelines. The interest rate is right about the same. It's the same thing for a second home as your personal residence. So we got a down payment. Could be as low as 3%, depending on what you're using the property for. We got a 620 FICO score. Now, what are we using for income? Now, this is really, really important to understand. If you're putting minimal down payment, we have to add the principal and the interest. We have to add the property taxes. We have to add the homeowner's insurance. We have to add if there's any homeowners association fees. And since you're putting a minimum down, we also have to add the monthly mortgage insurance, the PMI. Now, a lot of people say to me, Chris, I hate that PMI. Well, you know, if you don't have a big down payment, say thank you to the PMI companies, because otherwise you'd have to wait until you have 20% down in order to buy that house. So they're a blessing in disguise. They're really a gift for those people who don't have a ton of money. So we add that as a whole payment. And on a conventional loan, we're also going to add your car payment and your credit cards, the minimum credit cards. I'm sure you pay extra, but the minimum payment on the credit cards. We're going to add your student loans. We're going to add any child support or alimony that has to be paid, any other monthly debts. We're not talking about things like your cell phone bill. That's not a debt. You can turn your cell phone off tomorrow. I don't know anybody who does that anymore, but you can do that, okay? It's not your insurance. It's money that you borrowed, and what's the minimum monthly payment that you have to pay. And we take that amount, and it should be, if you're putting a small amount down, no more than 45% of your provable monthly income. So that's really important. Your provable monthly income, what's that? Well, how do you get paid? You get paid salary, you get paid commission. Commission, we're usually going to average over a couple of years. Salary, hey, it's a flat salary. If you get paid hourly, do you work 40 hours a week? Do you work 50 hours a week? There's some different combinations no matter what you do. Now, if you're paid hourly, here's a simple way to figure out how much you get paid monthly. We're assuming you work a 40-hour work week. If you work less, we're going to average it over 2 years. But if you work a 40-hour work week or even overtime, what we're going to do is give me your hourly pay, and we're going to multiply it by 173.333. It's just a shortcut. What we're actually doing is we're multiplying 40 hours times your hourly times 52 weeks divided by 12. It's the same thing. So take a look. We'll help you calculate it. We'll help you figure it out. Now, if you're working overtime, what we have to do is we have to get a verification of employment form from your job. And what we're going to do is we're going to average your overtime over the last 2 years to a monthly number, so that we don't give you too much income, because the risk associated with a loan depends on how they can sell the loan. And if they can't sell the loan, they're not doing the loan, so you're not buying a house. So we have to meet certain guidelines. That's basically how it works with minimal down payment. Now, if you have a larger down payment, if you have 10% down, okay, you're still going to be pretty close to 45%. But if you're at let's say 20% down. What they're going to allow, if you have good credit, they might allow you to go up to 49.5% or so, really close to 50%, and that includes all the payments. Why? Because you're putting more money down, more skin in the game, you've shown you have good credit, and they look at it as, hey, there's very little risk for us if they're spending all this money we have a lot of skin in the game. We're putting 20% down, $400,000 loan. You're putting, $100,000 as a down payment. That is a big deal to the lender and the safety and the security of the loan. And that's what it's all about. How safe is it for the lender? Now, Fannie Mae and Freddie Mac, you might have heard of them before. They have their own rules, but they're almost exactly the same for loans. And it's qualifications. How do you qualify? Everything today is proven on paper. I know I'm old, paper, but we can do a lot of it electronically, obviously. But if you can't prove it, it doesn't exist. I do have people who come to me and say, hey, Chris, I'm self-employed and I make $10,000 a month, and I look at their income taxes and it's like they made $32,000. How did they do that? Well, they wrote all the expenses off. Well, I don't want to pay taxes. Well, then you can't buy a house. So, it's only based on what we can prove through your income taxes. If you're not self-employed, obviously your W-2 and your pay stubs and a verification of employment. So we have a bunch of different tools. Is conventional the perfect loan? For some people, yes. Is it the best loan all the time? No. If you have the lower FICO score, it's probably not the loan for you. If you're looking at a large down payment, it's probably going to be beneficial to you. So we look at it as a whole. The loan officer will help you. It's a lot to calculate, a lot to look at, a lot of paperwork that we have to prove every single thing. If you've been divorced, we're going to need a divorce decree. If you've had a bankruptcy, we're going to need those bankruptcy papers. We need to prove everything to prove that you are ready to buy a home and fire your landlord. Call me, Chris Trapani. Call my staff, and we are ready to help you in every step of the way. You can fill out an application. All you got to do is go to my website, fireyourlandlord.info, click the apply button, get started today. Fill it out. We'll help you. We'll hold your hand through the whole process. Now, if you found this video helpful, do me a favor. Give it a thumbs up, give it a like, and you can also subscribe. You'll see all my other videos. If you want to leave a comment or have a question, just enter a comment. I'm really happy to answer. I answer every single question personally, and I'm happy to help you fire your landlord.